For more on this, let's bring in Dilin Wu. She's a research strategist at Pepperstone. Welcome back to the programme, Dilin. Now, we saw stocks recover to end the week on Friday, but what's driving investors to dump major tech stocks to start the week?
Well, I think what we're seeing is exactly a valuation correction and also sector rotation. I mean, semiconductors had an absolutely extraordinary first half. For example, Micron up over 260%, and this year, Sendix up over 635%. Some names nearly doubling in a matter of weeks. And when you run that hard, that fast, you don't really need a catastrophe to trigger selling. You just need an excuse, I would say. And actually, the market got two of them at the moment. First, we have internal factors. For example, Meta's cloud compute announcement sparked fears that AI capex discipline was tightening. OpenAI efficiency reports revived the DeepSeek kind of style anxiety about whether the industry actually needs this much compute. And Apple reportedly lobbying to source Chinese memory alternatives hit Samsung and SK Hynix directly. And second, we have the fast hawkish repricing that puts a lot of pressure on the high multiple growth names. But here's what I push back on. This isn't really a market distress. Money isn't leaving equities. I mean, it's rotating, and the Dow hitting record high while Nasdaq sells off tells you exact that. So what we need to look as the next step is obviously the earnings report coming up. So if we are seeing a higher than expected tech companies earning, then the sector could be supported.
Now, meanwhile, South Korea has launched its round-the-clock $1 trading system. How significant is this move for the internationalization of the won, and what could it mean for foreign investment in the country?
Well, I think this would be the most significant opening of the Korea's forex market. I think the strategic objective is quite clear to me. MSCI developed market reclassification, because the complaint foreign investors have made for years is that they couldn't really manage Korean currency risk in real time during European and the US session. So that friction has been a genuine barrier to capital allocation. And today, the barriers just calm down. And if the MSCI upgrades Korea, passive index funds globally are forced to increase their Korean allocations. And that's structural, sustainable inflow, not just hot money. And this is also Korea planting a flag in global capital markets. And the payoff, when it comes, will be quite significant, I think.
Looking at oil, we went from the biggest global disruption to a potential supply glut. Do you think the market can absorb extra supply at this point, or does it risk pushing prices even lower?
Well, I think the market can probably absorb it for now, but the window isn't wide open. Brent around $71, WTI below $70. Then the war risk premium has come off fast, and that's rational because Hormuz is reopening. The supply threat is largely gone, but U.S. inventories are still about 7% below the 5-year average, and refinery runs remain high. So you can't really call it a glut until you see stocks actually building, and we're not there yet. And the real risk is the demand side, I think. The IEA sees global oil demand falling 1.1 million barrels a day this year. And China's consumption is still quite soft. High fuel prices in the first half already destroyed demand in a lot of global markets. So if demand doesn't come back before inventories recover, every extra barrel that OPEC Plus pumps becomes a price problem, and there's a lot of extra barrels coming.
Dilin Wu in Melbourne, great to speak to you as always.